There are some important terms you need to know if you're going to use investment trusts. Investment trusts are companies whose business is investing shareholders' money. That investment is the job of a fund manager. As you can see from the list of 41 sectors, the range of investment trust activities is broad. Traditionally, investment trusts investing in shares in companies across the world or just in the UK have been popular with investors. But you can also find investment trusts investing in other regions and countries. Ultimately, the most important thing about an investment trust is its share price. As shareholders, you want the share price of an investment trust to go up, not fall. Market capitalisation, or market cap, is the total value of the investment trust, calculated by adding up the price of all its shares. The market cap largely reflects the amount of assets or investments an investment trust holds on behalf of its shareholders, but the reputation of its fund manager can be a factor too. Net asset value, NAV, is the value of all the assets an investment trust holds minus any debt it has. The ability of investment trusts to borrow money and invest it is a big advantage, as we'll see later. The NAV is a key measure of how good or bad the fund manager is at picking investments. Investors want to see the NAV per share go up. This is calculated by dividing the NAV by the number of shares. If the NAV per share falls below the share price, the investment trust is said to trade at a discount. In other words, the share price does not reflect the full value of the underlying investments. Its shares are cheap. Conversely, if the share price rises above the NAV per share, the trust trades at a premium or more than the underlying investments are worth. Its shares are expensive. Investment trust shares tend to move between discounts and premiums over time as they respond to changes in the stock market and investor demand. This can create investment opportunities. An investment trust share may fall to a discount if the market it invests in falls or if its fund manager goes off the boil. A brave investor who buys the shares then might see a good return if there's a recovery. This is because the share price will benefit from an improvement in the NAV as the market rises and a reduction in the discount as other investors return to the stock. However, for the same reasons, if you buy an investment trust at a premium when its shares are expensive, there's a risk it will fall more than you might expect in a downturn. Long-term investors don't need to worry too much about discounts or premiums. As long as your share price rises in line with the underlying investments the trust holds, you should do okay. Let's end with looking at investment trusts' ability to borrow money to invest, as it's a really important feature. This borrowing is known as gearing and is the main reason why, on average, investment trusts generate better long-term returns than other kinds of funds. The idea behind gearing is simple. It means increasing the amount of money investment trusts have at their disposal. In a rising stock market, a geared investment trust will do better than a fund that has no borrowing or is ungeared. However, in a falling stock market, shares in a geared investment trust will fall faster. There's also the danger the trust breaches its loan agreements with its lenders. This can force the fund manager to sell investments he or she wouldn't want to. Investment trusts typically can borrow up to 30% of their shareholder assets, although the amount they use will vary a lot. If the fund manager can get a higher return on these investments than the interest the investment trust pays on its debt, then gearing is worth doing. So that's gearing, and that's all I've got time to tell you about for now. We will return with more jargon busting later in the series.